Orange County home prices are at all-time highs, making homes difficult for buyers to afford given that interest rates have been kind of sticky. Most economists are projecting that mortgage rates will continue to decline, but if you want to buy today, how do we solve your affordability problem today? Hi, I'm Rosario with the Veronica Encinas team at Coldwell Banker Realty, and I'm going to explain why a buy-down loan program is becoming more popular and could be the answer to making your next home more affordable. Now, a buy-down loan program is one where the mortgage rate is bought down with an upfront payment, and that payment typically comes from the seller out of the proceeds of their home. Now, I'll explain later why a seller would do this, but for now, I'll focus on the mechanics of the loan. A typical buy-down program would be what's called a 2-1 buy-down. In a 2-1 buy-down, the interest rate would be 2% lower in the first year of the loan and 1% lower in the second year. The remaining years would be at the current interest rate. For example, let's round up and say today's interest rates are 7%. With a 2-1 buy-down, the buyer's rate in the first year would be 5% and in the second year 6%. These rates are probably closer to rates that you've been waiting for, and through a program like this, you can get those rates now and not have to wait a year or more to buy. Now, if these rates come down as predicted, you can refinance into another loan before this loan adjusts in a couple years. Otherwise, the worst case scenario, your rate is starting in year 3 at 7%. Now, why would a seller provide this concession for a buyer? Well, let's first look at how much it would cost the seller. Typically, it costs at least 2% of the loan amount to buy down the rate for 2 years. As an example, if a buyer puts 20% down on a $1 million home, they would have an $800,000 loan. The cost to the seller would be somewhere between $16,000 and $20,000 depending on the lender and the program. Now, if you're a seller, you typically would be willing to make this concession if your home's been on the market for a while, for example, and you're considering a price reduction. Going back to the $1 million home, if your home hasn't sold after a few weeks, a typical price reduction would be more. It'd be $25,000 and maybe even more. If a buyer comes along and says they'd be interested, but your price is too high, they may be telling you they just can't afford it at that price. By offering them a buy down and reducing their payment, that could be less expensive to you and to them. Back to looking at a buy-down program as a buyer. Now, if a seller's already offering a large enough concession in the MLS, you can use that to buy down your loan. If they aren't, however, you can always ask. Because at the end of the day, the seller cares about the net amount to them. So if you bring them a $1 million offer and ask them to pay $20,000 for a loan buy down, they'll see your offer as a $980 offer. And if that's better than any offer they've gotten or anything they think they can get in the future, you could have yourself a deal. Keep in mind there are many of these programs with varying amounts, so please talk with a lender you trust about all your options. And whether you're an Orange County buyer or seller, if you'd like help with financing and negotiating your Orange County dream home, reach out to us today.